Ever wondered what truly makes a company trustworthy? Beyond just the big numbers you see on a financial report.
Hmm.
It's not always about the flashy products or, clever marketing.
Right.
At its core, behind every really strong business, there's this unseen world, meticulous financial systems.
Exactly. The gears turning underneath.
Yeah, the intricate gears ensuring every dollar, every product, every investment is accounted for with, well, absolute integrity.
That's the goal, anyway.
So today we're pulling back the curtain on three really vital pillars of a company's financial health. We've got the cash cycle, the inventory cycle, and the investment cycle.
Three big ones.
Think of it as our deep dive into how money, goods, and assets actually move within a business and why these rigorous controls are just so paramount. Our mission, give you a shortcut to understanding these hidden mechanics that build financial trust.
And it's fascinating, isn't it, how these three cycles, which seem separate, are actually deeply interconnected. Effective controls within each, they aren't just about stopping fraud, though that's huge. They're about ensuring the very accuracy and reliability of the company's financial story.
Okay.
So we'll look at common pitfalls, some clever safeguards companies use, and how auditors come in as these sort of truth tellers, making sure it's all above board.
Right. So let's unpack the cash cycle first.
Yeah,
Because, well, when we talk about cash, we're almost always talking about high fraud risk.
that's spot on.
It's the lifeblood,
Right.
but also maybe the most tempting target.
Absolutely. Cash is, well, inherently liquid. And if internal controls are weak, it becomes a prime target. We're going to look at two pretty clever but definitely fraudulent schemes involving cash, lapping, and kiting.
Okay, lapping. It sounds almost gentle, like a quiet wave, but I get the feeling it's anything but. What exactly is this scheme?
Yeah, the name's deceptive. Lapping is where an employee, maybe someone handling payments, takes money received from one customer's payment for, personal use. Then, to cover their tracks, they apply a subsequent customer's payment to that first customer's account, the one they stole from initially.
Ah, I see.
It's like a financial shell game, really. Constantly moving money around to hide this hole that just keeps getting bigger over time.
That's incredibly sneaky. So how do companies even begin to guard against something like that, this continuous rolling deception?
Well, the key is really to break that chain of opportunity. Companies use several safeguards, things like independently comparing the recorded cash receipts with the actual bank deposits,
Okay.
making sure the person handling the incoming cash isn't also the person managing the account's receivable records. That separation is critical.
Right.
And also regularly providing timely statements to customers. That last one is pretty powerful, actually,
Why is that?
because customers will notice pretty quickly if their payment wasn't credited to their account when it should have been. They'll complain.
Ah, makes sense. Now, you mentioned a really elegant solution earlier, the lockbox system. Tell us about that.
Oh yeah, the lockbox. It's brilliant in its simplicity, really. Instead of customers sending payments directly to the company, they send them to a designated bank lockbox. The bank then opens the mail, processes the payments, deposits them directly into the company's account, and sends a statement of remittances to the company.
So the company employees never even touch the incoming checks or cash.
Exactly. It creates this immediate, independent layer of control. It drastically reduces the opportunity for schemes like lapping because the cash is out of employee hands from the start.
Very clever. Okay, what about the other one? Kiting. That sounds a bit more aggressive, maybe.
Yeah, the name fits a bit better, perhaps. Kiting involves playing a timing game between usually two different bank accounts.
Okay.
An employee might deposit a check drawn on one bank account into another account at a different bank. But here's the trick. They intentionally delay recording the disbursement from the first bank until after the reporting period ends, say, after December 31st.
So what's the ultimate goal there? Is it hiding a cash shortage, or maybe making the company's cash position look stronger than it actually is?
It can be both, really. It creates an intentional overstatement of cash because for that brief period around year-end, the same amount of cash appears to be in two different bank accounts simultaneously.
Like phantom cash.
Exactly, like a phantom balance. It's a way to artificially inflate cash balances on the books or cover up a deficit, at least temporarily until the check clears properly.
That's quite a maneuver. So how do auditors, these financial detectives, sniff out this kind of manipulation?
Right, auditors have specific procedures for this. To detect kiting, they prepare what's called a bank transfer schedule.
Well,
They look at all the transfers between the company's bank accounts, especially around year-end. They need to ensure that the date the cash was dispersed from the first bank's ledger actually precedes the date it was received in the second bank's ledger. If the receipt is recorded before the disbursement, that's a red flag for kiting.
got it. Timing is everything.
Precisely. They also use something called a bank cutoff statement.
A cutoff bank statement. What exactly is that? It sounds like another tool to catch these tricks.
It is, yeah. Think of it like a mini bank statement, but it covers just the first week or two, maybe 10, 15 days after the company's year end. And the auditor gets this directly from the bank, not from the client.
Okay. And how does that help?
It allows the auditor to see if the reconciling items on the year-end bank reconciliation cleared the bank promptly in the next period. Specifically, those deposits in transit the company listed, did they actually show up in the bank account right away? And the outstanding checks, did they clear the bank shortly after year-end?
Ah, so it verifies those in-between items.
Exactly. It's like checking if the mail arrived exactly when they said it would, right after that cutoff date. Helps catch manipulation of those items.
Makes sense.
But, beyond these specific frauds like lapping and kiting, strong internal controls are just absolutely crucial for the entire cash cycle. Not just for catching these schemes, but for overall accuracy.
And what's truly fascinating here, you mentioned before, is the emphasis on segregation of duties. Why is that so foundational, especially when it comes to cash?
It really is the cornerstone of internal control, particularly for cash. Proper segregation means no single employee has too much control or the ability to commit and conceal fraud on their own.
Right.
For cash, this typically means separating the person who handles the cash receipts
Yeah.
from the person who records those receipts in the accounting system
Hmm.
and from the person who reconciles the bank statements. 3 different roles.
And that applies even for small amounts, like petty cash.
Ideally, yes. Even for petty cash, you'd want separation between approval, custody of the fund, and record keeping. It creates this system of checks and balances where one person's work is inherently verified or at least reviewed by another's. Makes it much harder to siphon off funds unnoticed.
And for cash flowing out of the company disbursements, what's a key control there?
A strong system for disbursements typically includes using a voucher system.
Voucher system.
Yeah. This basically means that before any check is cut or payment is made, there's a complete package of supporting documents like an approved purchase order, the vendor's invoice, evidence that the goods were received, all reviewed and approved.
Okay.
This voucher package provides documented evidence that the payment is legitimate and authorized. It adds another critical layer of control before cash goes out the door.
Got it. So when the auditors come in, they've got all these controls to look at. How do they actually verify the company's overall cash position, the balance itself?
Right. For the cash balance assertion, the primary procedures involve sending bank confirmations and meticulously auditing the company's year-end bank reconciliation.
Bank confirmations are those just confirming the balance.
They do that, but they do much more. These are standard forms the auditor sends directly to all banks the client has done business with during the year, even banks where the account was closed or has a zero balance at year-end.
Oh, interesting. Why even the zero balance ones?
Because the confirmation asks about more than just the year-end balance. It asks about any loans the company has with the bank, any lines of credit, any contingent liabilities the bank knows about, like loan guarantees, or any pledged assets, meaning assets the company has used as collateral for loans. Really important information.
Wow. Okay. That's comprehensive. And the bank reconciliation, how do they audit that?
They really dig into the year-end bank rec. First, it literally just check the addition and subtraction to make sure the math is right.
Okay.
Then they agree the balance per the books to the company's general ledger and the balance per the bank statement to that bank confirmation they received directly from the bank.
Got it.
And crucially, they test the reconciling items, those deposits in transit, and outstanding checks. They trace these items to that cutoff bank statement we talked about earlier
Right.
to verify that they cleared the bank in the early part of the next period, just as they should have if they were legitimate reconciling items at year end.
Okay, so that nails down the year-end balance. But what about checking the actual flow of cash during the year, the day-to-day receipts and disbursements?
Good question. Auditors also test the transactions. For cash receipts, they're concerned with assertions like completeness, making sure all cash received was actually recorded, and existence, making sure all recorded receipts actually happened.
How do they test completeness?
For completeness, they might say trace source documents like remittance advices, those slips customers send in with payments forward to the cash receipts journal, and the bank deposit slips, making sure everything received got logged.
And for existence?
For existence, they'd go the other way. They'd vouch entries from the cash receipts journal back to the supporting documents like the remittance advice or the deposit slip, confirming that a recorded entry actually represents a real cash receipt.
Okay, and a similar process for disbursements, I imagine.
Exactly. For disbursements, they might trace canceled checks back to the cash disbursements journal for completeness, ensuring all payments made were recorded. Or, for existence, they'll vouch entries from the disbursements journal back to the canceled checks and, importantly, their supporting voucher packages, those stacks of approved documents we mentioned.
Got it. Confirms the payment was real and properly authorized.
Precisely. And beyond those, they're always checking for proper cutoff, making sure transactions are recorded in the correct accounting period, not shifted between periods, and valuation, confirming the dollar amounts are accurate, and presentation, ensuring cash is classified correctly on the financial statements.
And finally, wrapping up cash, making sure all this crucial information is transparently presented in the financial statement footnotes for everyone to understand.
Absolutely. Auditors confirm that all the required disclosures are there. This means clarifying the company's policy for defining what it considers cash and cash equivalents.
Right.
Any restrictions on cash need to be disclosed, things like sinking fund requirements, where cash is set aside to repay debt, or compensating balance requirements, which are minimum balances a bank might require as part of a loan agreement.
Right, things that limit the company's use of that cash.
Exactly. The auditors check that these are disclosed clearly and accurately, ensuring the overall presentation is understandable for anyone reading the financial statements.
All right, that's a great deep dive into cash. Let's move now from the incredibly liquid world of cash to something more tangible, the inventory cycle. For so many businesses, manufacturers, retailers, inventory isn't just stuff, it's their lifeblood, right? Often their biggest asset.
Oh, indeed. Inventory is huge for many companies, and controls over inventory are absolutely paramount. It's not just about the accounting for purchases and sales, but physically safeguarding the inventory itself from damage, theft, or just becoming obsolete.
And I'm guessing this is another area where that segregation of duties concept is really critical.
Absolutely. There's a very clear, logical flow of responsibility you want to see.
Okay, walk us through it.
Sure. It typically starts with purchasing. Their job is to prepare and issue serially numbered purchase orders, getting the right authorization. Then, receiving takes over when the goods arrive. Their responsibility is solely to verify the quantities received against the packing slip, check for any damaged goods, prepare a formal receiving report documenting what came in, and then deliver the goods to the warehouse.
Okay.
And here's a brilliant little control often used. The receiving department might get a copy of the purchase order, but it's blind that doesn't show the quantity that was ordered.
Ah, why do that?
It forces them to actually count the goods when they arrive, rather than just assuming the quantity on the PO is correct and signing off. It ensures an independent count right at the entry point.
That's a great detail. Prevents them from just rubber stamping it.
Precisely. Then next, you have the warehouse function. They act as the custodian, physically safeguarding these verified goods, keeping them secure.
Okay.
And finally, shipping. They are responsible for making sure goods only leave the premises after proper authorization, like a customer order and shipping approval, and that everything going out is properly documented. Each step acts as a check on the previous one.
That makes a lot of sense. So when the auditors step in, how do they actually verify all these physical goods, especially since inventory is often constantly moving?
Well, the single most important procedure here is the observation of the company's physical inventory count, usually at or near year-end. Observing the beginning and ending counts is actually a required auditing procedure under standard auditing rules, unless it's truly impractical.
So wait, the auditor shows up with a clipboard and counts every single box, every single item. That sounds like an impossibly huge task for most companies.
Yeah, that's a common misconception. The auditor doesn't count the entire inventory themselves. They observe the client's employees taking the count.
Ah, okay, so what are they observing?
Their role is multifaceted. They evaluate management's instructions and procedures for the count. Are they clear and designed to be accurate? They observe the client personnel performing the count. Are they actually following the procedures? They inspect some inventory themselves, checking for existence and condition, looking for dusty boxes in the back, potential damage, or obsolete items. And crucially, They perform test counts.
Test counts?
Yeah, they select a sample of inventory items, count them independently, and then compare their count to the client's count records for that item. It's a way to test the accuracy of the client's counting process without counting everything.
Okay, that makes more sense. What happens if, for some valid reason, the auditor just can't be there for the physical count at year end?
If it's truly impractical, maybe the inventory is in a remote or dangerous location, or if the inventory amount is just completely immaterial to the financial statements, then alternative procedures might be acceptable, but that's generally rare for significant inventory balances.
What about companies with really good inventory systems?
Right. If a company has a well-controlled, reliable, perpetual inventory system, meaning their records are continuously updated for every item bought, made, and sold, and they do regular cycle counts, then the auditor might be able to observe the count on a date other than year-end, maybe a month before or after. They'd then perform tests to reconcile the count back to the year-end balance, making sure all the intervening transactions were recorded properly.
Okay. So beyond just observing the count, what else do auditors do to get comfortable with the inventory number?
They perform tests on several core assertions, which are basically the claims management is making about the inventory in the financial statements.
Assertions like?
Like completeness.
Yeah.
Did they include all the inventory they should have? Auditors test this by tracing some of their test counts forward to the final inventory listing compiled by the client. They also check that all the pre-numbered inventory count tags used during the count are accounted for, none missing.
Okay. What else?
Valuation, allocation, and accuracy. Is the inventory valued correctly? Here, they check the mathematical accuracy of the final inventory listing. They look for obsolete, slow-moving, or damaged goods that might need to be written down to a lower value. They review vendor invoices to verify the cost of purchased inventory. And for manufactured goods, they test the company's calculation of labor and overhead costs applied to inventory.
That sounds detailed.
It has to be.
Yeah.
Then there's existence and occurrence. Does the inventory reported actually exist? The primary test here is observing the physical count. They'll also vouch items from the final inventory listing back to the physical count tags or test counts they performed.
Makes sense. And ownership.
Right. Rights and obligations. Does the company actually own the inventory? This is important. They need to make sure that any consigned inventory on hand goods the company is holding to sell for someone else but doesn't own is excluded from their inventory count. And conversely, any goods the company owns but has sent out on consignment to be sold by others should be included in their inventory, even though it's not physically there. They also need to check inventory in transit at year-end, making sure it's included or excluded correctly based on the shipping terms, like FOB shipping point or FOB destination.
Lots of nuances there.
Yeah.
And finally, just like with cash, making sure all this intricate information about inventory looks transparent and understandable in the financial statements.
Exactly. Presentation and disclosure. The auditor ensures all the required disclosures are present and clear in the footnotes. This includes disclosing the specific cost method used, like LIFO, FIFO, or weighted average, the overall valuation method, like lower of cost or market. They need separate balances shown for raw materials, work in process, and finished goods if applicable. Details on any inventory that's been pledged as collateral for loans or any significant consignment arrangements, and any large losses from inventory write-downs or potential warranty obligations related to sold inventory. The auditor reads those footnotes carefully to ensure accuracy and understandability.
We've covered cash, we've covered physical goods. Now, let's transition to the investment cycle. This involves how a company manages its financial assets, stocks, bonds, maybe more complex stuff. This can get really complicated, right? Especially with valuations changing, sometimes daily.
It absolutely can. Investments can range from simple to incredibly complex, and strong controls here are essential, especially given, as you said, the fluctuating nature of financial markets and the subjectivity that can sometimes creep into valuations. It's not just about guarding physical assets anymore, but safeguarding the company's financial future and reporting it accurately.
So where do the controls typically start in this sometimes more abstract investment cycle?
Well, guess what? Segregation of duties is paramount here, too.
Surprise, surprise.
Exactly. Ideally, the authorization for purchasing or selling investments, especially significant ones, should come from a high level, like the board of directors or an investment committee. This ensures the investments align with the company's strategy.
Okay. What about holding the investments?
For custody, having an independent third-party custodian like a bank's trust department or a brokerage firm hold the actual securities is highly recommended. It provides strong external control.
And if they don't use a custodian, if they hold certificates themselves.
If investments are held physically by the company, which is less common now for marketable securities, there should be joint control, meaning two authorized officials should need to be present to access them, perhaps in a safe deposit box. And periodic counts should be done, comparing the securities on hand to the records, ideally by someone completely independent of the investment function.
And record keeping.
Record keeping must always be done by a party separate from those who authorize transactions or have custody of the assets. Keeps everything independent.
Makes sense.
Controls also need to be really robust around the processing of investment transactions, buys, sells, interest, dividends, and, critically, around fair value measurement. Because how an investment is initially classified.
Classification.
Yeah, like whether it's classified as trading, bought and sold frequently, available for sale, might be sold before maturity, or held to maturity, like a bond they intend to hold until it matures. That classification significantly impacts how it's reported and valued on the financial statements, especially regarding unrealized gains and losses.
Okay, that sounds complex. So how do auditors tackle the audit of these investments, which could be anything from plain vanilla stocks to, I don't know, complex derivatives?
They approach it using those same assertions. For completeness, they want to make sure all investments are recorded. They might search for unrecorded purchases by examining transactions right after year-end to see if anything bought before year-end wasn't booked. Or they'll use those confirmations sent to third-party custodians to get a complete list of what's being held.
Valuation sounds like it would be a really critical and maybe tricky area for investments.
It absolutely is, especially with market volatility. For valuation and allocation, auditors perform several tests. They'll foot the detailed listing of investments provided by the client, check the math, they review the investment activity during the year, and they have to corroborate the quoted year-end fair values.
How do they do that?
For publicly traded securities, they compare the client's values to prices from reliable sources like SEC-registered exchanges or major financial data providers. For investments that aren't reported at fair value, like those held-to-maturity bonds, which are typically carried at amortized cost, they recalculate those values based on the original cost and effective interest rates. And a really important step is assessing whether any investment has suffered a permanent impairment, a loss in value that's considered other than temporary.
We'll need to come back to impairment. What about existence? Proving the investments are real.
Sure. For existence, the two main tests are confirmations with those custodians, asking them directly what they hold for the client, and, if securities are held by the client, physical examination.
Physical examination. They're looking at stock certificates.
Exactly. And this physical count of securities is often done at the exact same time the auditor counts the cash on hand.
Oh, why at the same time?
It's a control procedure to prevent the client from concealing a shortage by temporarily replacing missing cash with securities, or vice versa, between the counts. Counts them both simultaneously. Auditors also perform analytical procedures like checking if the recorded interest and dividend income seems reasonable given the investments held as indirect evidence of existence.
Clever. And for rights and obligations, proving the company actually owns these things.
That confirmation from the custodian is strong evidence of ownership, as is the physical examination if they hold them. Auditors might also examine brokers' advices or purchase settlement statements for securities bought during the year to confirm the company's rights to them.
Okay, that covers the balance. What about auditing the transactions within the investment cycle, the buying, selling, and the income generated?
Right. They test the transactions, too. They often use analytical procedures to test the reasonableness of dividend and interest income recorded for completeness. Does the income make sense based on the investments held and market rates? They verify the cutoff for purchases, sales, and income recognition, making sure transactions are recorded in the correct period. For valuation, allocation, and accuracy of transactions, they might independently recalculate gains or losses on sales, or verify interest income calculations, maybe comparing dividend rates to external sources like Moody's or S&P. Existence for income transactions is often covered by those analytical procedures. Reasonable income suggests the underlying asset exists. And finally, understandability of presentation and classification involves examining transactions to ensure they're recorded in the proper accounts, like distinguishing correctly between realized gains losses and unrealized gains losses for trading securities versus available for sale securities, because they hit the financial statements differently.
Got it. And what specific disclosures are particularly important for investments given their potential complexity?
Auditors need to ensure that all the required disclosures are included in the financial statement footnotes and that they're accurate and clear. This definitely includes details about any investments that have been pledged as collateral, any significant restrictions, or other obligations related to the investments.
Hmm.
They also review the methods the company used for accounting for the investments, their classification policy, trading, available for sale, held to maturity, and the methods used for determining fair value. It all needs to be understandable for the financial statement user.
Okay, this brings us squarely to fair value measurements. This can be incredibly complex, you mentioned. We often hear about level 1, level 2, and level 3 valuations in the footnotes. Can you break those down for us in a way that makes practical sense?
Yeah, this is where it gets really interesting, and frankly, where a lot of judgment can come into play both for management and the auditor. Fair value is supposed to be the price that would be received to sell an asset in an orderly transaction between market participants. But how you determine that value depends heavily on how observable the market inputs are. So, accounting standards set up this three-level hierarchy.
Okay, level 1.
Level 1 is the most reliable. It uses observable, quoted prices in active markets for identical assets or liabilities. Think of valuing a share of Apple stock traded on the NASDAQ. You just look up the closing price on the valuation date. It's right there. Clear, active market, identical asset. Minimal judgment needed.
Got it. That seems straightforward. Level 2.
Level 2 is still based on observable inputs, but they're not quoted prices for identical assets in active markets. This could be things like quoted prices for similar assets in active markets, or quoted prices for identical or similar assets in markets that aren't considered active. Maybe valuing a corporate bond that doesn't trade every day, but you can look at prices for similar bonds that do trade. Or using interest rate swaps valued using observable yield curves. There's still market data, but it requires a bit more interpretation or adjustment.
Okay, still market-based, but maybe less direct. Which brings us to level 3.
Right. Level 3 is where it gets the most subjective. This level uses unobservable inputs. These are inputs developed based on the best information available, but they reflect the reporting entity's own assumptions about what market participants would use.
So, company estimates.
Essentially, yes. Think about valuing a private equity investment, or a complex derivative with no market data, or maybe real estate where you're using a discounted cash flow model based on projected rents and expenses. These rely heavily on management's judgments and internal models. This is the least observable level, and therefore requires the most disclosure and the most scrutiny from auditors.
So, auditors clearly have a huge responsibility here, especially for those level 2 and particularly level 3 assets, to verify these fair values. How do they do that?
Absolutely. Management is responsible for making the fair value measurements and classifications, but auditors have to obtain sufficient appropriate audit evidence to support them. It's a big focus area.
What kinds of things do they do?
Well, they'll independently verify quoted market prices for level 1.
Hmm.
For level 2 and 3, they need to understand the company's process and controls over determining fair value. They'll evaluate the valuation methodologies used. Are they appropriate? They'll assess the reasonableness of management's assumptions, especially those critical unobservable inputs in level 3. They need to consider management's intent and ability to hold certain investments, as that affects classification. They might test the underlying data used in the models. Sometimes they might even develop their own independent estimate or range to compare against management's value.
Why?
And if the valuation is highly complex or specialized, like valuing intricate financial instruments, auditors will definitely consider using an auditor-employed or auditor-engaged specialist, a valuation expert, to help them assess it.
What if the company gets its pricing from a third-party source, like a pricing service or a broker? Does the auditor just accept that?
Not automatically. The auditor needs to understand and evaluate the methods and assumptions used by that third party. The reliability depends on several factors, like the expertise and reputation of the pricing service, their methodology, whether the service has any relationship with the entity that might impair objectivity.
And if it's a quote from a broker-dealer?
If it's a broker quote, especially for something less common, the auditor considers things like, is this broker a market maker who regularly deals in similar instruments? Does the quote actually reflect current market conditions? And, importantly, is it a binding quote, meaning the broker would actually transact at that price, or just an indicative one? Binding quotes from unaffiliated market makers are generally considered more reliable.
Okay, that makes sense. Finally, let's touch on impairment. Sometimes investments, unfortunately, lose significant value. When does that loss become official, so to speak? When might an impairment loss need to be recorded on the income statement?
That's a critical judgment call. Regardless of whether an investment is carried at cost, amortized cost, or fair value, if there's a decline in its fair value below its carrying amount, management has to assess if that decline is other than temporary. If it is deemed other than temporary, often shortened to OTII, then an impairment loss generally needs to be recognized in earnings.
And what signals other than temporary? What do auditors look for?
Auditors actively look for specific indicators that might suggest an OTTI. For instance, if the fair value is significantly below cost or amortized cost, especially if that decline seems related to specific adverse conditions affecting the security itself or the issuer's industry or maybe a geographic region. Another big factor is the length of time the fair value has been below cost. A prolonged period raises concerns. Also, management's intent and ability. Does management intend to sell the security before recovery? Or is it more likely than not they'll be required to sell it before recovery? If yes to either, impairment might be needed even if they think it could recover eventually.
What are some other red flags?
Other red flags auditors look for include: has the security been downgraded by a rating agency? Has the financial condition of the issuer deteriorated significantly? Have dividends been reduced or eliminated or interest payments missed? Or did the company record losses from this specific security after the balance sheet date, but before issuing the financial statements? All these could point towards the decline being other than temporary.
So it's really a combination of factors and judgment.
It really is. Assessing impairment requires significant judgment from both management and the auditor.
Wow. Okay, today we've really peeled back the layers on the cash, inventory, and investment cycles. It's become incredibly clear that while the headlines often focus on, the big revenue numbers or the quarterly profits, the actual integrity, the trustworthiness of a company's entire financial statement truly relies on these detailed, sometimes painstaking processes and the robust controls built into them.
It's fascinating, isn't it, how these seemingly technical, almost behind-the-scenes details, segregation of duties, cutoff procedures, valuation methods, really underpin the entire edifice of financial trust.
Yeah.
It's all about ensuring that what's reported in those statements reflects the economic reality of the business. And that's fundamental for investors, for creditors, for the public to have confidence in a company and the markets overall.
So what does this all mean for you, the listener? Well, next time you hear about a company's financial results, maybe you'll have a deeper appreciation for that intricate dance of cash flows, the physical movements and counting of inventory, and the often complex valuations of investments that make those numbers possible.
Right.
And it really raises an important question, I think. How much does our collective trust in financial systems, and indeed in companies themselves, ultimately rely on the diligence of those often unseen audits and those critical internal checks?
That's a great point, and maybe a follow-up thought. How much more transparent, how much more reliable could financial reporting become if every single company truly embraced and meticulously applied the most robust controls and practices we've discussed today? It's kind of a continuous pursuit of integrity, isn't it?
It really is. Well, thanks for diving deep with us today into these crucial cycles. We hope you feel a little more well-informed about the unseen mechanics that keep the corporate financial world spinning.